Hi. Let's learn about impairment in accounting. In accounting, impairment refers to a permanent reduction in the value of a company asset, which could be a fixed asset or an intangible asset. Impairment is often caused by a sudden decrease in the recoverable value of a fixed asset, usually due to unforeseen events such as natural disasters. For example, if a construction company's outdoor machinery is extensively damaged by a natural disaster, this would result in a large decline in the fair value of those assets. Accountants regularly test assets for potential impairment, and if impairment exists, they write off the difference between the fair value and the carrying value. This fair value is normally derived from an asset's expected future cash flows and expected salvage value. It's important to note that goodwill, accounts receivable, and even a company's capital can also become impaired. Impairment is an unexpected reduction in an asset's value, whereas depreciation refers to the expected wear and tear on an asset over time. Depreciation schedules allow for a set distribution of the reduction of an asset's value over its lifetime, unlike impairment, which accounts for a sudden drop in an asset's fair value. Under generally accepted accounting principles, assets are considered impaired when their fair value falls below their book value. Testing for impairment periodically is essential under GAAP, especially for assets such as intangible goodwill, which must be tested for impairment annually. Assets might become impaired and unrecoverable due to various reasons such as a change in an asset's intended use, a decrease in consumer demand, damage to the asset, or alterations in legal factors that affect the asset. An example of impairment could be a building that is damaged by a natural disaster. If a building purchased for $250,000 is now worth only $100,000 due to damages, the impairment loss should be recorded. This loss appears on the income statement and simultaneously reduces the value of the impaired asset on the balance sheet. The generally accepted accounting principles define an asset as impaired when its fair value is lower than its book value. To check an asset for impairment, the total profit, cash flow, or other benefit expected to be generated by the asset is compared with its current book value. Impairment losses are shown both on the income statement and the balance sheet. An impairment loss is recorded as an expense on the income statement and simultaneously reduces the value of the impaired asset on the balance sheet. The overall goal of asset impairment is to periodically evaluate a company's assets to prevent them from being overstated on the balance sheet. It's important to periodically check an asset's value to ensure prudent business management. Under GAAP, an impaired asset must be recorded as a loss on the income statement. Comparing the value of the asset to the fair market value helps determine this loss. Impairment refers to the reduction in the value of a company asset, and it's important to periodically evaluate the value of assets to accurately record their value on the balance sheet. Overstating an asset's value could lead to financial problems later on. Here are 5 key takeaways. 1. Impairment can occur as the result of an unusual or one-time event, such as a change in legal or economic conditions, a change in consumer demand, or damage that impacts an asset. 2. Assets should be tested for impairment regularly to prevent overstatement on the balance sheet. 3. Impairment exists when an asset's fair value is less than its carrying value on the balance sheet. 4. If impairment is confirmed as a result of testing, an impairment loss should be recorded. 5. An impairment loss records an expense in the current period that appears on the income statement and simultaneously reduces the value of the impaired asset on the balance sheet. Hope this would help. Thanks for watching.